Okay, so now we're going to have to walk through a lot of the other revenue recognition issues that go along with the things we've been talking about in the five-step process. Just little situations that are common enough. We're going to spend some time talking about them. The first one of these issues is a right of return. A lot of times a firm may make a sale and they give the customer the right to return the item at a later date. A lot of times the seller will give the buyer a credit. They might exchange it for a new item or obviously give them a cash refund. The key that we're going to be talking about here, though, is that there's going to be potentially an adjusting entry so that the firm's expectations are reflected in their financial statements. And so, in other words, in their financial statements, they might have net sales and they might have reported cost of goods sold that really, as far as their current measure in the year, in other words, the sales they've had to the point and the returns they've had to that point and what they've recorded as cost of goods sold, it may not really reflect their expectation. In other words, there may be some returns that have still yet to be made. And so the key is that we have this adjusting entry that may be necessary based on current year sales, but where the return has not yet occurred. And so I might have an expectation that 1,000 items are going to be returned. Maybe in the year, only 800 have been returned. And so now what do I do with the 200 that I still expect to be returned? And so we want to make sure that our net sales and our cost of goods sold reflect our expectations. And so if necessary, we'll make an adjusting entry to get there. I think an example is going to help, though. And so we have a company, they sell 50,000 products in 2018. I give you a price, I give you a cost. And they estimate that 4% of the products are going to be returned. And then I note here that 1,135 products have already been returned, and the clients had already been issued a refund. And so the issue here is, do we need to make an adjusting entry, and if so, how much? Well, the first thing we have to look at is, well, what is our expected returns? And so if we sell 50,000 products using the estimate of 4%, we really expect 2,000 of those units to be returned in total. However, only 1,135 units have currently been returned. Therefore, we expect another 865 units to be returned at a future date. Again, we're already to the end of 2018, and so now we've calculated what we expect to be returned in 2019 or beyond, but we want to record the effect in 2018. And so the first thing we have to figure out is, what's the sales revenue adjustment amount? And we just take that sales price of $10 per unit, multiply it by the future units that we expect to be returned, and we get $8,650. Similarly, we have to make a cost of goods sold adjustment. Similar calculation, except for in this case, of course, we use the cost and multiply that by the number of units we expect to be returned, for a total of $5,190. So now let's get to the journal entry. Okay, so then we have this adjusting entry that we need to make. The debit to sales return and allowances is just like we would have done if there had been a sales return during the year. Of course, during the year, there would have been a credit to cash or credit to inventory or some sort of credit for the client. But in this case, of course, there's no exchange that's actually taking place. We're anticipating a future exchange. And what we believe is there is now a probable future economic sacrifice that we're going to have to make. It might be giving them a new piece of inventory. It might be giving them cash. It might be giving them a credit. And so we now have this sacrifice that we expect to be making, and so we have a liability. We're just going to call that liability an account payable. At the same time, though, when they make the return, they're going to give us inventory back. And so really our cost of goods sold needs to also be adjusted. So in other words, when that return is made, we would credit cost of goods sold. Of course, during the year, we would credit cost of goods sold, and then we would debit inventory. But in this case, of course, the inventory has not actually been returned. The credit to cost of goods sold is the same. Now we're going to debit estimated inventory returns. Again, this is different than an actual inventory account because it's anticipating it. And so when the return actually takes place in 2019, we would credit the estimated inventory return account and we would debit our inventory account. There's also a repurchase agreement. A repurchase agreement is an arrangement where the seller agrees to a repurchase price that is equal to or greater than the original sales price. So they've agreed to basically repurchase the item from the buyer, and that price is either equal to or greater than the original sales price. Many times the seller is obligated to repurchase the good at a future date, although there are situations where there's a buyer option on the repurchase agreement, and it would qualify as a repurchase agreement if the buyer has a significant economic incentive to exercise the option. The key here is the seller should not recognize revenue related to the sale with the repurchase agreement. Under US GAAP, we really view this as a financing arrangement, and so they really haven't made a sale. They've just created some sort of financing arrangement for themselves. And so you cannot recognize revenue related to a sale where there is a repurchase agreement. Bill and hold arrangements. Normally, a seller cannot recognize revenue until control of the good or service transfers to the buyer. In certain situations, bill and hold arrangements can be made where the seller can recognize revenue before the buyer has taken physical possession of the good or service. There are 4 criteria before the bill and hold arrangement would allow for revenue to be recognized before the buyer takes physical possession. First of all, there needs to be an economic reason for the bill and hold arrangement, or some real reason. A lot of times this might be a physical space issue. The thing that US GAAP is really guarded against, though, is some sort of channel stuffing arrangement where basically there's no reason the buyer isn't taking it. You're just basically forcing them to record a sale beforehand. And so that's called channel stuffing. You cannot do that under US GAAP, but sometimes there's a physical space issue that would allow a bill and hold arrangement. And so the other thing is the item or the products that's been sold, it must be identified separately as belonging to the buyer. There must be some way to designate it as belonging to the buyer. The product must be ready for physical transfer to the buyer. In other words, it's got to be ready to go. And then finally, the seller cannot have the ability to use the product or direct it to another customer. An example that makes sense to me is a lumberyard sale to a construction company. So a lot of times a construction company might order lumber that they're going to use in the construction of a house or whatever it might be. And the lumber company might get the lumber done before the construction company is ready to take possession. So a lot of times the site is not prepared, or for whatever reason they're waiting on the county to complete some sort of inspection or something like that. And so for some reason, the construction company cannot take physical possession of the good. But a lot of times the lumber yard can set that lumber aside and identify it as belonging to that company, put it in a stall or something like that is separated and ready to be delivered to the buyer, to the construction company. And as long as they don't have the legal right to use that or direct it to another customer, then the lumberyard could recognize the revenue even before the construction company takes possession. But again, those 4 criteria have to be met. Another common example is a principal-agent relationship. This is a situation where there's a third party or a middle person that facilitates certain sales transactions. A lot of times in these transactions, you have to think about, okay, well, does the risks and the benefits related to the good or service, do they actually transfer to that third party? If they don't transfer to the third party, then really what you have is a principal-agent relationship. And the accounting, we have to be careful about what we recognize for revenue and how much we recognize as revenue. So what is the principal responsible for? What is the agent responsible for? These are questions that you have to ask when there's a principal-agent relationship. And then when does each entity, the principal and the agent, when do they fulfill their proportion of the responsibility? And that gives us an indication of the amount that we should recognize and when we should recognize it. So as an example, let's say that a customer books a room at the JW Marriott through Expedia for $150 on October 15th, 2018. The room reservation is for November 20th, 2018. Expedia withholds a $10 fee and remits the remaining $140 to Marriott. So how much should Marriott recognize? How much should Expedia recognize? And when should they recognize it? It's important here that Expedia actually never accepts responsibility for the reserved room. It is not their job to provide the reserved room. It is JW Marriott's job. And so because of that, Expedia can only recognize their $10 fee. But they can also recognize it on October 15th because as soon as the reservation is made, they've really fulfilled their obligation. And so there's nothing left for them to do. They can recognize the revenue. For JW Marriott, they do have the responsibility to provide the room to the customer. And so they can recognize the full $150 that the customer paid, but they would have to subtract $10 as a cost of goods sold or some sort of commission or something like that. And secondly, they would have to wait until the reservation is actually complete, the stay is complete before they could recognize that revenue. So they'd probably have to wait until November 20th or potentially November 21st before they could recognize the revenue. Consignments. Again, with a consignment, the consignee never takes legal possession of the good or the service, and so they cannot recognize the revenue for the full retail amount. The consignee only recognizes its sales fee. So as an example, there may be a situation where a consignee sells a $100 piece of furniture and they charge a 10% fee to the consignor. And so the consignee can only record $10 in revenue. The consignor would record the full $100 and would probably have a $10 commission cost or something like that. Warranties. In previous usually when we talk about current liabilities, we would talk about assurance type warranties, which basically protect against defect. Those warranties really are talking about when do we record a warranty expense. What we're talking about here is a service type warranty, and so this is an additional source of revenue. We're not talking about a warranty expense. We're talking about a type of revenue. And so when we talk about service type warranties, you can recognize those separately, and they should be separately priced and separately recognized. So this would be a warranty that's independent from the sale. I just wanted to make sure we distinguish between warranties with regards to current liabilities compared to what we're talking about here. Again, before it was assurance type warranties, and now it's a service type warranty. Non-refundable upfront fees. The key here is that the fee is inherent to the good or service that's being reserved. So the buyer isn't paying a fee for no reason. They're paying a fee in order to receive the good or service at a future date. Therefore, the seller cannot recognize revenue for the fee until it has performed. In other words, until the service has been provided or the good has been provided at that future date. Some examples, let's say that I reserve a NASCAR experience for $500 and it requires a $50 non-refundable fee. Well, even though I might pay the fee today in order to reserve the experience, the seller of the NASCAR experience can't recognize the fee until the later date when the NASCAR experience actually takes place, because the fee is inherent to the NASCAR experience. A catering service is similar. There may be a non-refundable deposit or something like that, but the caterer cannot recognize the revenue for that deposit until the catering service has actually taken place.